Welcome to the Portland Real Estate Podcast, Oregon and Southwest Washington's #1 show for real estate news and information. Without further ado, here are your hosts and a couple of guys who, as busy realtors and successful brokerage owners, know a thing or two about real estate. Steve Nassar of Premier Property Group and Joe Fistolo of Soldera Properties.
Hey there.
Hi.
We are back.
Good morning. It's Fed Day.
It's Fed Day. Important day today.
Yeah. So we're doing welcome everybody to the Portland Real Estate Podcast. We're doing a special episode today, kind of timed around, a big Fed decision that I don't think is a surprise to most, if anyone at all. It was pretty well expected that there would be a 0.25% cut to the Fed funds rate, which is exactly what happened. There's some interesting happenings around that we'll be going into. Joe and I plan to do a thorough discussion of the current real estate market as we are seeing it in the front lines. And then we've got some great topics just to touch on from Masters in Real Estate, some happenings in the industry and what people are talking about. So, Joe,
Right.
How are you doing?
I'm doing great. And, we have this uncanny way of timing our podcasts exactly when there's a big announcement, right? We, when the NAR settlement thing happened, we just went live. And today, the FOMC, Federal Open Market Committee, thought they were going to reduce their rates by 25% from about 4% to 3.75. And for those of you, what that means, it's the rate being cut is the federal funds rate. And that's the rate the banks charge each other for overnight loans. And lowering that makes short-term borrowing cheaper, but it doesn't necessarily attribute to your interest rate on your loan is going to be 25% cheaper. It sort of leans that direction. But anyway, it's a very timely day today that's being done at the time we're looking at a market overview, because everyone wants to know how we're going to finish out the fourth quarter. And they also want to know, all right, what are the predictions for 2026? We getting better? We getting worse? We staying the same? And holistically, it's all positive. It's going to be a slow improvement of what we have today through 2026. They're expected to have rates in December of 2026, maybe in the high fives. Some people say it'll hover around 6. Some people
We were really close today.
maybe high fives.
We touched some lower levels today that I haven't seen in a couple years. On CNBC, they always flash the 30-year fixed. I think they get it from Mortgage News Daily, if I'm not mistaken. Which it's an apples and apples comparison every day, right? And 6.13 is what they were showing, and it's been hovering in the 6.2s for a while. So the 10-year note yield was. It did rise a little bit today, but it was down to below 3.9. And that is closely tied to mortgage rates.
It is. And so I crunched some numbers myself, and last week's average interest rate was 6.19%. And that's the lowest average we've had in 13 months, which is pretty amazing. The other thing I saw on the other end of the scale is if you look here locally in the Portland metro area, Tri-County area, our absorption rate is 3.8%. And our inventory is as high as it's been since way back to 2014, January 2014. It was about 4 months, and we're at 3.8. So this is the highest it's been in about 12 years. And if you don't know what absorption rate is, they figure it out in months. So if you look at our current inventory, And if there's no new listings, no new homes being built, no new homes on the market, that's how long it would take to exhaust what we currently have. Almost 4 months. And a lot of economists say that 4 months is kind of the balance of the market, not necessarily a seller's market, not necessarily a buyer's market, but it's kind of even. We're not oversaturated with inventory, or undersaturated like 2020 and 2021 when
I like that you say it 4 months.
6.
I always used to hear, Joe, that it was 6 months that was balanced. And I agree with you. I think 4 months feels more balanced to me than 6 months. 6 months seems like a lot of inventory.
Well, it does.
Have you heard that historically? A lot of times they would say 6 months is considered balanced.
Yeah, it's a little bit higher than 4, but I think they're kind of correcting that. And
I agree.
The thing that we get into is there's someone stinky in every market. Right? In 2020 and 2021, sellers would sit back. They would have 12 offers. They'd go 175 grand after ask, and people are giving away the farm. I waive my inspection. I'll guarantee the appraisal gap, all this other stuff. But if you look at what happened in 2007 to 2012, it was the other way around. We had 18 months absorption rate, and the buyers are like, I don't have to buy. And I might buy your house, but I'm going to offer you 150 grand less. We don't have to buy, but you probably have to sell if you're trying to sell in this market. So there's good and bad with both. So cutting the rates is good. We can all agree that if this attributes to a lower interest rate for new loans, you got to think of the economic data of why they're doing it, because they're trying to spur the economy. It has to deal with our population. It has to deal with our inventory. It has to deal with our inflation. So the feds are thinking we need to do this to keep the ball rolling down the field. And so you got to look at, for every benefit, there's a cautionary reason why they're doing it. And as you know, when there's lots of changes and lots of question marks floating over everyone's head as to where is our economy going, most people, the de facto answer is, I'm going to shelter in place. I'm not going to do anything. I'm going to sit back and wait until I know something. So it's good and bad, but holistically, I think it's good. And the forecasts, I've been just analysis paralysis by watching all these economists, but the net of it all is we will increasingly get better through the fourth quarter and all the way through 2026, where the rates should get even a little lower than where we are today. And that should promote more real estate activity. But there's so many factors, a big one is your employment, which our employment rates haven't been off the chart good or bad. It's okay. But that's one of the factors.
That's when we can get them, right? Because with the government shutdown, there's a lot of data not coming out of what.
Absolutely. Yeah.
And that's a whole nother challenge that's being dealt with right now. In many ways, but as it pertains to what we're saying, now the Fed is kind of flying a little bit blind, right? Because normally they're getting regular reports on on employment and various other inflationary reports that now are not coming out. And so they're making decisions without seeing data. And that's unique.
Well, true. And I think we're sort of in a good position. Okay, so 2007 and to 2012 was a murder scene. It was just the worst. And then they came out with the Dodd-Frank thing to sort of limit risky loans, super verify the purchaser, get rid of interest-only loans, and they had lots of layers of rules so we wouldn't go back there. No one wants to see 2007 over again. and they kind of overcompensated and made it a little bit too restrictive. And then it was like 2018, Congress passed the economic growth regulatory relief thing. And they're like, okay, we kind of overcorrected with the Dodd-Frank. We understand the purpose, but let's not make it impossible for people to get loans. And so they did soften it a little bit. And we've been moving along well since then. But the biggest objection in the last 3 years has been the darn interest rate. And I think we'll see
3.5 years now.
Yeah.
Isn't it crazy how time has flown?
Significant improvement. I think the magic number is under 6. If we get under 6, people will be buying and people will be selling, and it will kind of be the new normal.
Yeah.
But right now, the affordability is just so difficult.
Yeah. Some great stuff there, Joe. Let me dive into this a little bit here. So first things first, you are correct. What happened today does not directly affect mortgage rates, with a couple of exceptions. With a couple other caveats. I shouldn't say exceptions. First of all, and this is something important to mention to all of our listeners, the Fed gave us some free marketing in real estate today. Free advertising. Think about it. Tonight at 6:30 p.m., Nora O'Donnell and every other news anchor in the country is going to tell all the American people that the Fed lowered the Fed funds rate 25 basis points, right? Let me ask you, Joe, how many of those people think that is mortgage rates? Would you say more than not?
I think so many people think, hey, it's our loans are cheaper.
So somewhere in America, many, many times over, hopefully, there's going to be a housewife watching the 6:30 news who's going to go, honey, maybe now it's time to think about buying a house. We've been crammed in this house. We've had 2 kids in the last 3 years. We need another bedroom. I know our mortgage rate is 3%, but maybe this is now getting it close enough to make it possible. Call Joe, call Steve. Let's start talking. Okay?
Yeah, right.
That is positive. I also believe something similar will probably happen in December, right? The next Fed funds meeting. And into next year. And keep in mind, we've talked about this, I think, on the show, and it's worth repeating. Sometime next spring, around May, Chairman Powell is going to be replaced by a Trump appointee who we can assume is going to be fairly aggressive in their stance of wanting to lower rates. Okay? So there is those positives for the industry, regardless of what directly happens today to mortgage rates, which started the day, by the way, as I said, some of the lowest rates I've seen in a couple years. And they might have ticked up since then, but okay. The other thing that is going on, and this cannot be understated, the Fed also announced in their statement that they would be ending the reduction of its asset purchases. That's a weird thing to say. If you actually think about what I just said, ending the reduction of asset purchases. I think it's kind of like a double negative almost, but what it basically means, let me start this by speaking of 2008. There was, you and I were in the business back then, Joe. It was gruesome. We talked about that. There was a time in 2008, and I remember it vividly, where everything in housing was going to hell in a handbasket. Okay, the foreclosures were spiking, and we knew that something horrible was happening. At the same time, mortgage rates were elevated. I want to say, believe it or not, they were lower than where they are today, but I want to say they were in the mid 5s, high 5s. Don't quote me on that, okay? And the Fed knew in order to weather this housing storm that we were going to go through, and by the way, they had been dropping the Fed funds rate and it wasn't affecting mortgage rates. That's important to also say. They knew that in order to weather the storm, and in the months to follow, the government did all sorts of stuff. Remember when they gave the free tax credit? They were doing all sorts of stuff to help housing start to slog through this mess. The Fed started buying mortgage-backed securities, okay? That is quantitative easing. QE, they called it, right? And all of a sudden, mortgage rates started dropping. And it was this aha moment, because I don't think we had ever really seen it before that I'm aware of. It was this aha moment that, hey, the Fed has a tool. They can lower mortgage rates, okay? Beyond the Fed funds rate, which you and I just said does not correlate directly to mortgage rates. And in doing so, I believe, if I'm not mistaken, they dropped pretty quickly into the mid fours. And I was a mortgage lender at the time, and all of a sudden we started having some refis. And it was like a lifeline in the business. So the Fed does have some tools at their disposal. They're not necessarily saying they're doing that yet, but they're moving in that direction. And I think that is exciting. And when you couple that with what I just said a little bit ago about a Trump appointee is going to come and replace Powell,
that's going to be huge.
You could see where more of that could be coming. And the what they are saying now is there's a thing in their world called runoff. And runoff, you'll probably hear this in some of the statements being said. Runoff is where the Fed has a balance sheet where they have a bunch of mortgage-backed securities. Runoff is when somebody refinances their loan, it falls off that balance sheet. If somebody sells their house, think about it, that mortgage goes away, right?
Done. Right.
That's runoff. Thus far, when there was runoff, when there was things falling off the balance sheet, they just let it fall off the balance sheet. And they said, so what their balance sheet was getting smaller just naturally through runoff. They are now saying as things run off, they are going to take that money and buy treasury bills, short-term treasury bills, which can reduce mortgage rates, okay? And an analogy that I heard somebody that I was talking to the other day use. This is the equivalent of the Fed saying, we're taking our foot off the brake. Their foot was on the brake, okay, of a car, right? Their foot was on the brake. They're saying we're taking our foot off the brake. They're not saying we're pushing the gas per se, but we're taking our foot off the brake on the quantitative easing. The exciting part could be if they decide to put their foot on the gas. And it is exciting because there is challenges with inflation, right? Inflation is still elevated. It is still around 3%, which is higher than target. They wanted at 2%. So they can, if they choose to, and I believe they will in the near future. And if it's not Powell, it might be the next guy. And by the way, there's a whole conversation I had with somebody recently where Powell's probably going to be a lame duck here in a few months because Trump's going to appoint the new person, and that person's going to start speaking and having more clout than Powell, who's on his way
out. Right.
So it's exciting because while inflation is elevated and the Fed funds rate is more closely a lever to control inflation, they might be able to start doing some quantitative easing that drops mortgage rates while not having to mess a bunch with the Fed funds rate, which or not have to do dramatic things with the Fed funds rate. So I've heard very smart people predict that it is quite possible, and you just said it yourself, that we could be in the high fives soon, and maybe even as soon as spring of next year, maybe even in the mid fives. Okay. Nothing's for sure. There's a lot. No one has a crystal ball. There's a lot of wild cards to that. But man, would that be good for our business, right, Joe? I mean, here's a couple things that it does. I agree with you. first of all, it brings that gap between those 3% mortgages and what's available today much closer.
Well, we're finally going to see the market we want to see. If you're a lender or a realtor, we've gone through all kinds of turmoil, but so back in the 2020, 2021, houses were appreciating off the charts because the rate was 2.5 and people were buying them, in my opinion, overpaying for homes, but they have a 2.5 rate. Well, then you fast forward and then the rates went up at its highest point to 8.25 just for a short period of time. And then it's hovered around 7, 6.5. And then that's where you get the golden handcuffs. The people that have a 2.5 rate, why would they possibly sell their house and buy another house if, they're not going to pay cash for the house? And really the only people selling it was like divorce or foreclosures, right? But they're not going to give up that 2.5 rate. As the rate
not for 8, not for 7.5, not for 7.
But if we're in the fives, and look, 2.5 was kind of the lowest, and let's just say an average of 3.25.
Yeah, and I think 2.5 is an exception out there. I'd say.
So if you say 3.25 to 5.5, that's not such a big deal, right?
Yeah.
People move because of great things in your life and bad things. And the good things are getting married, having babies, getting promoted in your job. And the bad things are death and divorce and, getting fired or laid off. Real estate doesn't slow down for life. Life happens. And then when you have a need to buy or sell, you buy or sell and, cross your fingers that you're buying low and selling high, but it doesn't always work out that way. But we're finally getting something balanced where we are today, we're easing into better conditions from now through the end of 2026. And if you look at the industry consolidation, like how many lenders are out of the business over the last 3 years? I mean, there's 20% of them left doing what they do. And then look at the real estate industry. There's far less of us now than there ever were. I remember 2000, we used to call them the 2012ers. We hit the bottom and then everyone jumped in and things were flying off the shelf. And we had lots of people coming into it as competition, which they weren't necessarily the best at what they do. They were just sort of interference. They kind of got in the way of real estate sometimes when you would normally get a listing and someone listed with a new person who got their 2012 license because it's their uncle or their best friend or whatever. Well, our market since then has corrected and overcorrected. And, arguably, I don't know if our market is better or worse now than 2020, 2021. I wouldn't want to go back to that. Multiple offers. A buyer has to make offers on 10 different homes and they have to provide a love letter and do all these things to beg to get their offer accepted well over listing. Well, look at today. Yes, the interest rates are higher, but our prices haven't been escalating like it used to. In the average, the prediction for 2026 is we're going to see about 1.5% appreciation in value. So our prices today are not going to be that much different than December of 2026. So I think that's good holistically because with inflation and the affordability and the prices of houses, it's very difficult for people in that bracket of, age 20 to 45 to buy something affordably. And so I think I'd rather take a balanced market at almost 4% absorption rate where it's not necessarily a seller's, not necessarily a buyer's. Obviously, the seller has to ask something reasonably close to market value. They say within 3% in order for someone to make a run at it. And the buyer has to come in with a good enough offer that a seller would give it consideration. So I think everyone's kind of playing on more of a balanced field, and I would take this market over a one-sided market any day. And for those of us that do this at a high level, I think next year will even be better.
Mm-hmm. Well, let me back up real quick and address that. It occurred to me as you were talking that homeowners out there have to weigh two pains and decide which pain is greater. Okay. The pain that they are feeling in their house with it not being the right house. Okay. And let me give you an example. You got 3 kids and you got 3 bedrooms, and those kids are growing and they need another bedroom. You need another bedroom. Okay. There's a lot of other pains you could have. I mean, suddenly you're promoted. Suddenly your work tells you, hey, work from home, and you don't have a home office, right? That would be another pain, right? You can come up with a lot of different pains, right? As a growing family. Actually, and there can also be pains with downsizing, right? Too much house. There's people who've been out there, Joe, for a while, who they vocally tell me, I'm not going to downsize because the mortgage on my smaller house would be more than the mortgage on this much bigger house. And while I don't need all this house, and I'd love to not have to vacuum rooms I don't use, why would I do that, right? That's pain. So there's that pain. The other pain that they have is the pain between their current mortgage, the current mortgage rate they have, and market rates available today. Okay. If they have a 3% mortgage rate, when we were at 8%, God forbid, because that was horrible.
Yeah.
Right. That is a massive pain. And that is a far bigger pain than most of the other pains they were feeling with regards to their house, right? Like it would take somebody, if somebody, let's use it, I'm just going to use an example in our world, right? If somebody lives in Albany, Oregon, and they get a new job in Portland, right? Maybe prior they worked in Albany, right? Or Salem. The pain of driving to Portland might look okay for a while compared to the pain of 5% difference in your mortgage rate, right?
Mm-hmm.
Going
Right.
from 3 to 8%. You might go, look, I'm going to drive for a while. Now that those rates are coming down, and now that they're 6, and and hopefully even lower, that pain starts to look less painful than the drive from Albany to Portland. And I'm hypothetically making a random example. You can use this in many other scenarios out there. As that number comes down, the pain incurred of changing mortgage rates diminishes. Now, suddenly the pain of the existing house they have seems greater. Not
Sure.
to mention that pain is compounded the longer that pain is out there, right? If you have, I'll use the example of you've got 3 kids and you got a 3-bedroom house, so 2 kids are sharing a room, right? And maybe in 2023 those kids were 8 and 10, and it was cute for a while. Now they're 11 and 13. Right?
Walls are closing in. Yeah.
The longer that pain lasts and the more squabbles there are and fights and, separating the kids, whatever the case is, right? The more that pain gets exacerbated, right? And so that other pain of the changing of the mortgage rate diminishes. So a few things are working in our advantage. Rates are getting closer to what people have. Time is going by. And that pain is being felt longer. And so I think we're going to start seeing a little bit more motility, more movement in the housing market. One of the telltale signs, I'll finish with this, Joe, and I'll let you jump in. One of the telltale signs that I encourage our realtor listeners to pay attention to, because I think this will tell you, and I've seen a little bit more of this recently, and every time it happens in my world, I get really excited. For several years, we were not seeing our past clients call us and say, hey, Steve, I'd like to sell and buy another house in our market. Whether it was a move up, move down, just a buy sell. Remember those wonderful phone calls for many years we had, Joe? They were twofers.
Yeah.
Calling you and they're like, hey,
sold us this monster house 15 years ago. The kids are gone and we want you to sell it and we want a one level.
You sometimes get the downsized ones because they have some cash to play with.
Yeah.
But the upsize ones are the ones I've noticed tremendously have almost, they'd gone dormant because people were just staying put. I've started to notice a few more of these coming in, not gobs of them, but one here, one there, one here, one there. Hey, come out. We want to do something different. Come check out our house and let's start talking about a search. For several years, most of the clients I've been working with were either pure sellers, and what I mean is they're only selling, or pure buyers, are only buying. A lot of times the sellers were selling, leaving the area, or they're going to do something different. The buyers, they didn't currently own a house, or they were going to rent their house because they love their mortgage rate and they're going to buy something, right? But the buy and sells are a telltale sign, as if those start to uptick, that's a telltale sign that gap between mortgage rates is closing enough that people are doing that. And it's really exciting.
Well, and I'm glad you said that, because the other telltale sign is whenever you see a substantial increase in people remodeling or putting on an addition, that means, hey, I'm not going to get rid of my low rate. I can't buy. If I bought $200,000 less, I would have a higher payment than what I currently have. We're staying. And so they will do an addition or kind of make a house that doesn't fit their family or lifestyle actually work. And these are the two catalysts. Like the biggest reasons is a substantial increase or decrease in family. You get married later in life. This person has 2 kids. All of a sudden now you have 3 kids in a house when you only had 1, and you just simply don't have the room for it. If it's not conducive in the market for their rate and their finances to go buy something, they're going to make it work and remodel. And granted, that is painful, right? But I think the one that's a non-starter is when you're looking at mobility. If you got to look at our population and their mobility. So you look at elderly people, obese people, people with a handicap. They absolutely cannot be in a 2 or 3-story home. And could you have a primary bedroom on the main floor and a kitchen on the main floor and main level living? You can, but you're still paying exorbitant amounts to heat the place, cool the place. The taxes are going to be through the roof. And ideally, they would be better in a one level, the perfect size for them. And I believe that our market, where we're coming up to, is going to be conducive for a lot of people to make the change. And then the factors that buyers look at, a lot of them are shopping. If I buy this house with this price and this taxes, what's my monthly payment? That's really all I care about. Other people are, what's the interest rate? That's most important to them. And then finally, what we call the rent trap is, what's the down payment needed in order to purchase this house? And like oftentimes people that are renting, their rent payment is not unlike a mortgage payment, but the rent trap is they don't have that 10% or 20% down to put forth in order to buy a house to get that mortgage rate. So they're sort of stuck in the rent trap. So those are the other variables.
The other thing about the rent trap, I was just talking to someone about this the other day. The other thing about the rent trap sometimes too, Joe, is sometimes the mortgage payment is a little higher and they don't want to bite that off. So they keep renting. But guess what? Rents go up. Right. And then 3 years later, the rent is higher than what their mortgage would have been then. But home prices have gone up. So now they still would have to bite a higher mortgage payment to buy. And they don't want to do that, so they keep renting, and it just keeps cycling over, right? And then they never take that leap, get a mortgage that's a little higher than they're comfortable with renting right now, but it stays a fixed and while rents continue to go up. Yeah.
Absolutely. And the economists that talk about our younger generation, they're not very nice. But in short, the problem is we have too many people spending lots and lots of money on depreciating assets. Hey, it's fun. Everybody loves to have a ski boat, an ATV, a Sprinter van, all this other stuff. That's a depreciating asset. So whatever you pay for it, when you go to sell it, you're going to sell it for less, and you also have to maintain it. And you're not building equity, you're building debt. And I know it's fun, but gosh, maybe get a house under your belt first before you say, hey, I'm going to get a Sprinter van and travel for 3 years before I get my real job and settle down. You know, they say the best time to buy a house is 20 years ago. Well, if you don't have one, the best time to buy a house is today.
Yeah.
So stop by. Don't go get your, double soy, cinnamon, pumpkin spice, a macchiato every single day for $6. And don't buy stupid crap. And you will thank yourself when you fast forward and you're in the ripe old ages, and then you can retire well versus having to work and scrap until you're 70 years old. I mean, all the people that are the Walmart greeter that are like 75 years old probably had lots of cool toys growing up, or maybe they never really saw their full potential in the job. But if you can control it, don't buy the stuff you don't need. Sock it away in real estate. Real estate is the number one proven thing for wealth building. So why wouldn't you do it?
Yeah. I saw another interesting statistic on social media. It was by an industry person stating, and I don't know fully where they got their data, but I trust them. They're with a large title company, and it's a reputable person. They said that the average rate out there on, I think I screenshotted it to you too, Joe. The average mortgage rate on all houses out there, not new houses, all. If you take every house in the country and you take their mortgage rate and you divide it by the number of houses, it's just now ticked above 5%. Okay.
Right. Yep.
And for a long time there, it was under 5%. It was probably well under 5%. But if you think about it, Joe, this makes sense. Every month, new mortgages are closing, and they have been for years now. 3.5, by the way. They're closing at 6, 6.5. They were 7. They were 7.5. Those are lifting the average up. Okay. So just now, that average rate out there, because there's a lot of those now being added into what the average is, it's now just above 5%. So there is some comfort in that as time goes by, that average is lifting, and there are mortgages out there that they're not all in the 3s, right? There are many that are above that. And yeah, it's that lock-in effect is real. It's been real. We've felt it for several years. It's the reason why transaction counts are the lowest they've been in 30-some years, right? Back to 1995 is what I've always heard.
Yeah.
But hopefully hopefully you would think, I mean, again, we're going on 3.5 years of this. The Great Recession, which I said this to somebody the other day. I said something about the Great Recession. He goes, I was there. It wasn't that great. The Great Recession was only 4-ish years, and it was bad. So I have to believe that demand is out there. It's waiting for that gap to close between the rate they have and current available rates, and we'll start to see a tailwind of activity causing more transactions that will dramatically help our industry. And remember, and actually there's a lot of belief in the powers that be, yes, the Fed and the current administration, they do believe that housing has been depressed for probably too long. And it does need to start moving through. And remember, Joe, there's a lot of ancillary industries that are fed by housing.
Right.
Home Depot, furniture stores. I mean, title, escrow, mortgage. I mean, it goes on and on. We think a lot about the ones that are really close to us, like the title, escrow, mortgage. But there's a lot of times people think about buying stuff for their house when it's a brand new house, right? And there's very few limitations on what that is. So it's a huge chunk of the economy that has been pretty stagnant for some time. So I'm optimistic that we will see some type of quantitative easing discussed and maybe implemented at some level, hopefully in the near future.
Well, and if you talk to
everything else,
if you talk to the older generation that's been in their house, 50 years, and it's like, hey, what'd you pay for your house? Just curious. And they're like, oh, I bought this house. It was $16,000, but the interest rate was 18.9%. And $16,000 back then, is like 10 times today or more. But that interest rate made the affordability like horrible. I don't really mind interest rates in the fives, and I know we've appreciated a lot, and I know we've sort of stopped. In some markets, we've gone backwards, and some it's a stalemate. But they're predicting appreciation of about 1.5% of what we can see of what your house is worth today by the end of 2026. So not tons of appreciation, but the fact that the rate's coming down, you have lots of people still looking to buy, and more people, like you said, with that delta of what your interest rate is and what the current interest rate is. If you were to make a change, it's minimizing that gap. When it's a 3% or 4% swing, all of a sudden it's like, I'm going to die in this house. I'm not giving up this rate. But when it's sort of negligible, people will make that move, either laterally or maybe out of state. A lot of people were moving to Arizona and Texas because the affordability rate and everything else. And I don't know that those people necessarily say, I'm going to be here for my whole life and then I'm going to move to Texas or Arizona. I think they're doing it thinking about the next 20 years. But if their heart is to stay here and they can do that, and you're not going to get killed on inflated home prices and inflated interest rates, then I think it will keep a lot of people close. And since there's far less of us doing this, it's going to make people that handle their job professionally and ethically, and they wake up every day hustling. It's going to be a fabulous business for realtors and lenders moving forward. And what I always notice is the end of January when the NAR dues come out, they're probably around $700, next year. And if you were down in business or never really did a lot of business, and that payment of $700 comes, that's when the bottom of the barrel drops off. Their partner is going to say, gee, you sold 1.75 units or properties this year, which isn't a lot of money. And now you're going to have this $700.
How do they sell 0.75?
Well, it's an average. So you have people that sell 100 houses, and then you have
I'm sorry,
people that sell none.
I was teasing you because the partner is saying you sold 1.75 units specifically.
The garage and bedroom gets cut off.
Yeah.
But on average, and that's why 10% of us sell 90% of the real estate that's out there, and the 90% of the brokers who don't do it at a high level fight for the 10% that's left. Mm-hmm. And the more we can get rid of some of those people, I think the better for our industry, the better for the professionalism and ethics. And look, I wish everybody worked at a high level, but that just isn't the case. And I think holistically, as we ease towards a better real estate market, I think the professionalism will go up, and I think people can transfer title back and forth, and it isn't completely lopsided to a seller's market or a buyer's market. So, and it right now it says it's slightly weighted to a seller's market, but that seller still has to be realistic in price, right? If you're above what it should sell for, it ain't going to sell, even though it's slightly weighted in your favor. So,
Yeah. Well, I think we did a good job of unpacking the state of the market, especially as it pertains to the Fed funds rate and what's going on with mortgage rates. Let's jump into we have a couple quick topics we just want to quickly touch on, Joe, with Best of Masters and some stuff that's been out there.
yeah.
Well, some of our listeners may not realize this. You've got to, because you're the administrator of the Masters group, you've got some cool back-end analytics that shares with you the most active posts,
Right.
which I think it points out which ones had the most likes, the most comments,
Most
and,
engagements.
most engagement. So let's just talk about a couple of these that we identified would be interesting to talk about. There was one about scams that you were mentioning, and I have a little bit to say about this. I've had a couple recent I've had one recent situation with somebody tying up one of my listings with what I thought was a scam.
Well, the scams are in full force, and if you listen to the Pat Stone WFG update, and he did it with Ken Perry moderated, and there was another guy, Doctor something or other, I forgot his name. WFG, according to what Pat Stone said, I don't know if you know the answer. So if you know the answer, don't answer it. But do you have any idea, like, how many times scammers try and break into their computer system a month?
I think you said it before we were on the air, and it was a big number, so I won't say it. I think I do remember what you said. Started with a 6 and
80,000 times a month. That's like constantly getting scammers and phishing and emails and all kinds of stuff. I mean, cybersecurity is a big deal, and that has to do with our market as well. And so there's all kinds of scams there. And if you can't figure out where the angle is, then you might be subject to someone who lost $50,000. But let's see, there were two Best of Masters scams going on out there.
What was about this roof one? Why don't you give the synopsis of that one, Joe?
So
that one got a lot of likes, 110, 112 likes, something like that.
So what happens is, when someone hires a contractor to do something to their house, paint it, put on a roof, landscape, put on an addition, whatever it is. And now the trend is those people stick a sign in the yard because all of their neighbors are thinking, hey, they're getting a roof. Maybe we should get a roof. And then they go and talk to their neighbor and they like, hey, how do you like your people? How do you like your people? It's like, oh, they're great. They're here on time. They show up. They're reasonable. And so there are scammers that go around that house that's getting on a new roof, and they solicit all the neighbors and say, hey, we're putting on a roof for John and Mary, a couple doors down, and we like to keep all of our men and workers and equipment and materials in the area, and we want to give smoking deals to everyone in the neighborhood, and then we can just work on this neighborhood and then move on. And so they give these sweet deals for roofs, and people in the neighborhood give them, half up front. And
somebody just got a free roof. That's a crazy story.
They're paying someone who isn't that roofer. And then this scammer is also calling contractors to go put a roof on the house, paid on completion. And so the homeowners are there and they see the trucks pull up and the people are like putting the roof on and they're like, this is great. And then the roof is on and then the person says, hey, I want payment. And they're like, well, I already paid you half, so I'm only paying you half for the finished, or we want payment for the entire thing. The problem is the person doing the work wasn't the one that got paid. It was somebody else. And so in that post, there was a vacant house that got a new roof, and the people that put the roof on was actually the one that got scammed because they were not hired by the seller, and they put on this whole roof and they're looking for payment. And it's like, we didn't hire you, show our signature on a contract where we hired you. And so essentially this vacant house got a free roof, and the contractor really should have known better. I mean, you have to treat your business like a business, and they got scammed. And sometimes it's hard to identify where the scam's coming from, but
yeah. Can I tell you something, Joe? There's a lot of scams out there. Do you know the ones that scare me the most are the ones where I can't figure out what the angle is? Like, what are they trying to gain here?
Yeah.
Those ones are the scariest because you can usually, if somebody starts asking for money, you go, okay, you're scamming me and I'm not giving you money. Okay. But if somebody starts in this, I guess you could say this is an example of that, where they aren't asking for money and they're just going through the motions of normalcy, it's really unnerving when you later find out that it's a scam. And you're like, how would I have known? Because they weren't asking. There's no angle here. I'll give you an example. Okay. We have a listing in Happy Valley. A Redfin agent that I know and trust reached out. She said, I've been working with this buyer for a while. They were an overseas buyer. They're from another country, but I think they lived here, but they had ties to another country. That came into play because they made an offer cash on the listing. They produced some proof of funds that were a little weird looking because they were in another currency from another country. Mm-hmm. The one thing we did right that I'm proud of, we did not move it to pending status. We said, hey, because these funds are a little not the norm, we're going to leave it active until you deposit earnest money. Well, long story short, 5 days go by, no earnest money is deposited, and the person is giving these. There was a lot of red flags. They left the country to go get the funds. They really want the house. And they were also throwing these little breadcrumbs that made it, my brother lives in the neighborhood. I want to live close to my brother. Bottom line is it never went anywhere. We went back, we got out of contract because they didn't deposit earnest money. Fortunately, our history wasn't affected. Luckily, we are in escrow with a different buyer now, a good one. But we're just like, what was their...
How do you get money? How would the scammer get money on that?
What, other than disrupting our lives, messing with our sellers' lives who go through the ups and downs of being in escrow and thinking they have a deal, and messing with the buyer's agents' lives and a lot of wasted time. What are you trying to gain? And I would be remiss to tell you, Joe, I feel like I see that stuff more and more all the time. There's another agent in my company, good agent, who he got ran through the ringer for like 3-4 months by some buyer who was professing to have millions of dollars he needed to invest in real estate. He jumped through all sorts of hoops to give the impression that he had these funds, showed proof, introduced him to money managers, all sorts of bizarre stuff that in the end, there was nothing to it. It wasn't real. He actually went into escrow on a very expensive house and did disrupt their history. And in the end, never bought anything. And we still don't know what his angle was. What was he trying to do other than waste people's time? And I've seen posts on Masters about that too. So be aware, there are scammers that are obviously out for some, and it's obviously a scam. They're fishing for the wire. They want you to wire them money, and those are obvious. There's also scammers that have no identifiable angle that we can perceive.
Well, and
as far as what they're trying to accomplish.
That's you gotta find out who benefits, right? The private detectives say follow the money, right? And they're getting good. What they do is they prey on older people and they say, hey, there's been a breach in our bank system. And they have this person on the phone and, all the information they have on the dark web, they have lots of information on them. And they'll say, hey, this is your account number. this is your social security number. This is this. And they give them some information, and the person's like verifying it all. But then they ask the questions that they don't have the answers to that they need. Like, hey, just to make sure that you are Mr. or Mrs. Jones, I'm going to ask you, what's your favorite food? Where were you born? I'm going to ask you these questions. That's what they're fishing for, so they can move forward with the scam. And you see those fishing expeditions all the time, and it's a horrible way to make money. I always thought if those people would put their efforts into a real job, they'd be multimillionaires, but evidently scamming people is easier. And I think those guys deserve to go to prison and serve their life in prison, but they're vapor. It's really hard to catch those people. And once the money's gone, it is next to impossible to try and get it back.
Yep. Let's move on from that one. Mark Alto, he was on our show, if I remember correctly, right, Jeff? Yeah. We had him on. Yep. He did a nice post October 1st about the government shutdown and how it affects our industries, primarily to do with mortgages. But I actually have one of these right now. I'll just tell you a quick story. I've got I want to say it's 100-acre parcel. It's farm. It's very much a farm in Hillsboro, not a little ways off of Highway 26, not too far off Highway 26. We went live about a month ago, 4 weeks ago. We just got an offer in the last week. It is some type of specialty farm loan. I don't know. It's some type of special farm loan.
There are residents on it, so it's commercial and residential.
Yeah.
There are farm loans out there, and those are hard enough as it is.
Yeah, and the offer came in. It's got like 120-day close, and it says specifically we can't do anything until the government reopens. Right? They can't move forward with the loan. Now we did accept. I think we countered and we got into contract with them. And they are doing some due diligence, and hopefully the government opens up soon, even though, and I know we talked about this a little bit here already, but there's not near as I can tell, there's no imminent signs of the government reopening and them figuring things out and finding, some neutral ground to get things agreed upon. But anyways, Mark Alto,
it's going to definitely slow VA appraisals.
Yeah.
So if you have anything VA, that's going to be slower. I think they require wet signatures for Social Security verification, a whole bunch of stuff. And the net of it all is, with the federal shutdown,
USDA loans are completely shut down. No commitment or approval.
We can see. If you close on time in 30 days, you're lucky. Maybe it's a conventional and a lot of money down, but if it's VA or FHA and USDA is completely shut down, you can add 10 days to 6 weeks to your closing or more.
I have a client. He works for TSA. He's been a client of mine for over 10 years. And I just checked in with him. I was just doing some, check in with clients, and I sent him a text just to say hi. He's been a repeat client of mine many times over, and he goes, doing okay, working and not getting paid. But that is a thing too. One of the things that was pointed out on this post is if a worker is a federal employee and they're furloughed, income cannot be used for qualification until they return to work. So if somebody is working with a client that is a government employee not being paid or furloughed, that is a problem. Flood insurance, be aware there's some flood issue. There's some issues with new flood insurance being validated.
And with those jobs, they really only need they need confirmation of 2 paychecks, but only 1 paycheck prior to closing. So, but you got to get that paycheck, and if you're furloughed, you aren't getting it.
USDA loans, no new commitments are being issued. I don't do a lot of USDA, but they're out there. FHA loans, some condo approvals may be delayed. So there is impacts. It's not massive, but they're out there. Let's see, what else were we going to talk about? I think we covered.
Yeah. The main thing is we talked about the market, and at the beginning we could have just said, okay, the market is slowly, increasingly getting better. And then that would have been our 30-second podcast. But that's the net of the market. We are ever so slowly getting better, but there's going to be no big booms, no high rises, no crashes. We're not going to see the appreciation that we had seen. And there's going to be more and more activity because there's going to be more people in the game with lower rates.
Yeah. Yeah, I think we're good. I think we covered some great stuff. We went for about an hour here, Joe. Great to reconnect. Great to have our listeners tune in and hear us on this exciting day where, we're seeing a little bit of easing in the done by the Fed, which I think we all welcome, very much so.
Thanks for tuning in. Make sure you like and subscribe, and we'll see you on the next one. Hey everybody, thanks for tuning in to the Portland Real Estate Podcast, Oregon and Washington's #1 show for cutting-edge real estate discussions. Also, I'd like to give a shout out to the members of Masters in Real Estate, a private and exclusive Facebook group, and the #1 source for all real estate topics. Thanks for being there, gang. I love you. Finally, I want to thank our faithful listeners. Without an audience, we're just two guys talking to each other. Make sure you hit the subscribe button so the new episodes automatically come to you. Make it great.